The hidden landmines, RMDs, Social Security, taxes, and IRMAA. In the first video of this series, Joe explained the idea that retirement taxes are not determined just by how much income you have, but where that income comes from. Then in part 2, John introduced what we call the bridge decade, the 10-year window where retirees often have the most control over their income and tax planning. But even when someone understands those concepts, there are still several hidden landmines that can derail an otherwise well-designed retirement strategy. These are the issues many retirees only discover after the fact, and unfortunately, they often show up later in retirement when the ability to fix them becomes much more limited. Today, we're going to talk about 3 of the most important ones: Social Security taxation, required minimum distributions, and Medicare IRMAA surcharges. Individually, each of these can increase your tax burden, but together they create something even more dangerous: unintended consequences when financial decisions aren't coordinated. Before we go any further, I'm Mark Schreiber, CPA, Senior Partner at E3 Wealth. With more than 30 years of accounting and tax experience, I help families and business owners make more confident decisions around investments, taxes, and retirement planning. Now let's get started. Many retirees assume that Social Security benefits are tax-free, but that's not always the case. Under the tax code, Social Security benefits become taxable once something called provisional income crosses a certain threshold. Provisional income is calculated as adjusted gross income plus tax-exempt interest plus 50% of Social Security benefits. For married couples filing jointly, the thresholds are below $32,000 of provisional income. None of the benefit is taxable. Between $32,000 and $44,000, up to 50% may become taxable. And above $44,000, up to 85% may become taxable. Now, here's the important detail. Those thresholds have never been indexed for inflation. They were established decades ago, which means more retirees fall into the taxable range every single year. Now, there's where Roth accounts become incredibly important. Qualified Roth withdrawals have very unique characteristics under the tax code. They do not appear in adjusted gross income, which means they also do not count toward provisional income when calculating Social Security taxation. In practical terms, that means a retiree who funds spending for Roth accounts can often keep their provisional income lower, which may allow a larger portion of Social Security benefits to remain untaxed. This is one key reason Roth assets are so powerful in retirement income planning. They provide income without increasing the tax calculation itself. The second landmine is something called required minimum distributions, or RMDs. Under current law, retirees must begin taking withdrawals from traditional IRAs starting at age 73, with the starting age gradually increasing to 75 for younger cohorts. And once those withdrawals begin, they're mandatory. The IRS determines the amount that must come out of the account each year based on the account balance and life expectancy formula. Every dollar withdrawn is treated as ordinary taxable income. The problem many retirees face is this: they allow their traditional IRA to grow untouched through their 60s. Then RMDs begin. The balance has grown large enough that required withdrawals are substantial. Those withdrawals can push retirees into higher tax brackets, increase the amount of Social Security that becomes taxable, and in some cases even trigger higher Medicare premium. In other words, one decision, allowing the IRA to grow unmanaged, can create multiple downstream tax consequences. The third landmine is Medicare IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. It's essentially a surcharge added to Medicare Part B and Part D premiums for higher income retirees. For 2026, the first IRMAA tier begins at approximately $106,000 for single filers, $212,000 for married couples filing jointly. If income exceeds those levels, Medicare premiums increase, sometimes significantly. And here's where things get tricky. IRMAA is based on a 2-year look-back rule. That means the income reported in your tax return today determines Medicare premiums you'll pay 2 years from now. So a large taxable event in 1 year, like a major Roth conversion or IRA withdrawal, may unexpectedly increase Medicare premiums down the road. Now, to be clear, Roth conversions are often an extremely valuable strategy. They allow retirees to move money from a traditional IRA to a Roth account, paying tax today in exchange for tax-free income later. But conversions are taxable events. The converted amount increases adjusted gross income in that year and counts toward IRMAA thresholds. That doesn't mean conversions are a bad idea. In many cases, they create enormous long-term tax savings, but they need to be calibrated carefully. A conversion that saves thousands of dollars in future tax could temporarily increase Medicare premiums if it pushes income above the IRMAA threshold, which means the decision needs to be evaluated in context, not in isolation. And that brings us to the most important takeaway. None of these rules exist in isolation. Social Security taxation, required minimum distributions, Medicare IRMAA, Roth conversions. They're all interacting inside the same tax system. And when financial decisions are made in one account at a time or one advisor at a time, unintended consequences become much more likely. That's why retirement tax planning requires coordination across the entire financial picture. In the final video of this series, we're going to step back and talk about something important. Is a zero income tax retirement actually the goal, or is the real objective something else entirely? We'll talk about when zero income tax is achievable, when it isn't, and why reducing your lifetime effective tax rate may be a more important outcome. If you'd like to explore the full analysis behind this strategy, you can download the white paper link below. If you'd like help evaluating how these ideas apply to your own retirement plan, we invite you to schedule a conversation with our team. Because when it comes to retirement taxes, the difference between a good outcome and a great one often comes down to coordination. Thank you.